And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, joined today by Jay Jacobs of Global X Funds, Todd Rosenbluth of CFRA. Let's start today with a major milestone for ETF. It's approaching $4 trillion in market capitalization. Todd, what does this say about the growth of the industry? What, it took 2 years to go from $3 trillion to $4 trillion, and yet I remind everybody, the mutual fund business is $19 trillion. So It's got a long way to go to really catch up with its big rival.
Right, we are seeing market share shifts. So we are seeing investors gravitate more towards the lower cost, more passively managed index-based ETFs. So $4 trillion is a huge milestone for the industry. We at CFRA think we're going to see further growth. The adoption of fixed income ETFs that's happened thus far in 2019 is a really big deal because we're seeing broad asset allocation strategies using this. And some of the more trading oriented products really started to pick up in June.
Yeah, and Jay, that is a surprise. We keep seeing inflows into bond ETFs, but I can't help but notice 2017 and 2018, oceans of money came into ETFs, particularly passive equity indexed in ETFs. There's money coming in 2019, but it's much slower. It's not negative, but it's much slower. I'm wondering, why has it slowed down when there's still compelling reasons? Seems like a lot of people still have money in fairly high-priced mutual funds.
Yeah, we have to remember that ETFs are highly liquid vehicles, and so they attract many different types of investors. Some people are going to be very long-term buy and hold and like the ETF structure because of its tax efficiency. Other people are going to be very quick, moving a lot of money in and moving a lot of money out. I think this year some of that hot money is maybe staying on the sidelines or looking at different investments rather than using the ETF vehicle. But if we look at the long-term trend, ETFs are still growing very fast.
Is that what we're looking at then? So there's a lot of tactical trading now in ETFs. We have to remind people that there are active traders that are moving money in and out of ETFs all the time. And if all of a sudden, like December, they decide to move to the sidelines, then the assets under management are going to drop.
Right, so we saw that again in May also. So there was outflows towards U.S. equity-oriented ETFs, but they came roaring back in June. So the triple Qs, SPY, were some of the more popular ETFs in general, and we saw strong inflows into those in June. And we think we're going to see that again in the second half if the equity markets continue to perform well.
And yet 19 trillion is a long way to go. Mutual funds, 4 trillion in ETFs. Isn't the real problem that mutual funds still own the 401k business? Unless you crack the 401k business, I don't know how ETFs are ever going to come close to mutual funds in terms of assets under management.
Right, so the 401k market is largely a buy and hold forever part of it, and mutual funds fit in very well there. The trading aspects that ETF offer are not as appealing, the cost structure versus institutional funds, so we do really need to see that to see the gap shrink considerably.